Hello all. Today we are going to discuss a controversial topic which you all will be having in your mind, which is where to invest, whether in mutual fund or in stocks, or do you have to invest in both stocks or mutual fund, and what is the basic criteria for opting in between the stocks and the mutual funds, and the proportion of money to be invested in both. We'll discuss it all in the session. If you are liking our content, please do support us by liking and subscribing to our channel. And if you have any suggestions or topics which you would like to include and you would like to explore, then please feel free to comment in the below session so that I will know about that and I can research and share you the details through another video. So let's directly get into the topic: stocks versus mutual fund. So already you know that stocks are pieces of business. So you are having a market capitalization for the stock. So it's like a part of the business. So promoter is holding a part of it and the rest is listed in the market, and you are owning a number of shares in that stock, and that much percentage is the ownership of yours in that stock or in that company. Wherein in mutual fund, it's a pool of funds. It is having some number of stocks, it is having some number of bonds, some gold, some commodity, some cash. So all these things. So based on the type of mutual fund, the holdings portfolio can vary, but end of the day, it is a pool of investments. So now how to choose between them? So before getting into the topic, I would like to bring in an analogy here, which will clearly explain what to choose. So if you want to go to Mumbai from Pune, so you can opt to go through a cab by hiring a cab, or else you can drive by yourself by your own vehicle. So if some people like me who love to drive will opt to drive by myself, because we guys enjoy the thrill of driving the car by ourselves. But some people is not comfortable driving say 200 kilometers by themselves, and they would like to relax in the back seat, so they will opt to go in a cab or hire a driver to drive your cab. So this is the difference mainly between stocks, investing in stocks, and mutual fund, I would say. Because if you want to go through or sail through the thrill of researching, analyzing, investing, learning, then again experiencing the things and noting down the learnings, and again uh, correcting your wrong decisions in the earlier time, and again reinvesting, so that is the path of stock investing. So that requires some time, some dedication. If you are working in a company, then you will have to dedicate some extra time in your leisure time to not go out with friends and enjoy, but you may have to sit analyzing about the stocks. And yes, it is fun even discussing it with your friends, and they also enjoy it, and that is another way of looking at it. But if you see mutual funds, it is actively managed by a fund manager, so you don't have to put all the efforts. You can simply invest your money, say through a lump sum, or say for tax saving purpose in ELSS, or for long-term goals through mutual fund SIPs. So this can help you build wealth without burning your time. So it's like a actively managed fund manager or fund house will take care of your requirements. But only thing is that, again going back to that analogy, so if I'm having my car and I'm allowing the driver to drive the car, the way I take care of my car, the driver may not take care of the car, because the car is mine and the driver is driving the car. So the thrill also you may not get, and also the way the driver handles the car and the way I handle the car, because it's my car and I am very much concerned about any damage or anything happening to the car. So I will take care in that way. So this may not happen with the driver. Similarly, for a mutual fund, he is not there just for you. He is pooling a lot of funds from various investors, including you retail investors. So he has a larger goal. He may not be concentrated on your specific goals and your specific needs and your return requirements and your appetite of stock selection or the type of stocks you are interested in. So this difference can be there in the mutual fund way of investing compared to individual stock way of investing. Now let us get into details of first mutual fund investing and second stock investing. So main thing, as I mentioned, in a mutual fund, you don't have to spend your time. You just have to find out a good fund. If you are going through a direct means, or if you are going through regular means, even you don't have to spend not even a time. So your broker will select the particular mutual fund, which I would not recommend. You have to go through direct fund only, because again I have explained about the loss in NAV and the money you lose over a period of time. Hope you have seen that video, the last session. So in that case, you have to opt a good mutual fund and then go for a SIP investment or lump sum investment in that. Once that is done, so the fund managers then later on will take care of the fund portfolio management or selling some stock, buying some stock, putting some cash for new buying and etc. So he will take care of that. But obviously he will get some management costs for that through expense ratio, through NAV rates, etc. Also, fund houses, large fund houses like Axis or Kotak or Mirae has got direct connections with the company owners because they are large fund houses. They are investing in the company, so they have direct access to the company owners and their financial team, so they can discuss and they will get more fair idea of what the business is and how it's going to develop or grow in the future. So this will help uh, do more due diligence and invest properly compared to individual investors, wherein I will not get that much direct access to the company owners or the management. Mutual fund obviously helps get into diversification, wherein in stocks you have concentration risk because you are investing in 1 or 2 stocks or say 5-10 stocks, wherein in mutual fund you have got a huge portfolio of stocks which with diversification. So this will have a diversification effect which you may lose or you may not have in the stock portfolio. If you talk about the negative side of the mutual fund, this mutual fund managers can have biases. You have heard various fund houses having such issues lately. So these fund houses may be influenced by the company owners in many ways. So they can have a biased view and they may invest in some stocks which are not actually fetching good returns, or maybe some private interest is there in that. So this will not happen in other case, wherein we are directly investing in the stocks. Also, the fund managers who is managing the fund is under immense pressure for performing. Also, they need more cash inflow. So performing is like, if they are not performing or they are underperforming, it is more pressure. So they will try to put into conservative investments like bigger companies or blue chip companies, and they will try to mitigate the risk by conservatively investing, but thus lower risk means lower returns also. So this can impact your overall portfolio returns compared to stocks, wherein I can aggressively put the money into whatever stocks I want, maybe small cap or whatever fast growing companies. Yes, risk is there, but I can also sell off the stock if I find any fundamental changes in the company, which is not actually there in mutual funds. Also, the commission is paid for the fund manager based on the increase in the size of the fund, means the fund inflow. So as the size increases, then the performance also gets impacted, because if it is small fund, then you must have seen funds like quant fund wherein the investment itself is low, so their returns are very high, and you must have seen fund houses like Axis wherein the mutual fund portfolio itself is as high as 33,000 crore, etc. So that huge capital or huge AUM, asset under management, means the performance also can be impacted, because the large sum multiplying it takes a lot of time and effort. So uh, the the fund managers will have that their own pressure, because if the fund size is very large, then the returns also will be impacted, which is not there again in the case of stocks. Also, exit and entry is something which is again a tension case for fund managers. So if somebody is exiting at the if the market goes down, then there will be a lot of exits. Actually, it should be time for investing, because you will get a rupee cost averaging and buying it at low. But normally there is a herd mentality and people go for redeeming the mutual funds. So at that time, the fund managers has to liquidate and they will lose that in that compounding effect, and also they will have to keep some cash liquidity in the market. So if they are getting 100% cash inflow, you will see in every portfolio of mutual fund there will be some 5 to 10% cash, which is like if there is a redemption coming in, then he will liquidate that cash and he will not actually liquidate his investments, because if he had invested the 100% fund into some portfolio, then if the redemption is there, then he'll have to liquidate that portfolio and he may incur losses in that. So that is another pressure which is again absent in stocks or in direct equity investments. Now talking about stocks will take a lot of time for research. Yes, if you find it interesting, then it is very good. So you get a lot of knowledge, you get a lot of world knowledge, macro and microeconomic fundamentals. You will get clear. You can speak confidently in a mob, in an open forum, because you have to do a huge number of research and you have to be clear on all the fundas of economics and finance. So this will give you a separate or extra edge, maybe in your career as well, if you are related to something related to the financial or related things. Here the other negative thing is that you don't have any control and you may not have any discipline in this, because you are having cash, you can buy anytime, you can sell anytime, so there is no proper guidelines for the selling and buying of this. So if you do a wrong judgment and you enter or exit the stock, you can incur losses. So discipline is not there, unlike a SIP wherein you religiously give the amount every month and your fund managers properly allocates the fund into various stocks or investments. Also, I say that mutual fund should be goal oriented. So you child's education, your new car or new house or some commercial property, buying of some commercial property, or your retirement, etc. So you need to have a goal and you need to have a consistent SIP, and you have to also put in proper amount and calculate the final amount, assuming some conservative returns over the year, and then decide the mutual fund portfolio. But as far as the stocks is concerned, it cannot be goal oriented. It is like wealth generation, another stream of income, you can say. But it should not be goal oriented. It should be like you can invest and you can multiply the wealth. And if something goes wrong, you may have the negative thing also. But that negative things is normally mitigated in mutual funds because of the diversification thing in that. So whatever money you have invested in religiously every month punctually, from the salary or income to your mutual fund SIP, the money left over after that should be utilized for buying stocks, or maybe some earlier stocks which has reached the target and you have booked the profit, then that amount can be reinvested into new stocks. That is how stock investing works, and this is the basic difference between mutual fund and stock investing. So hope this session was useful for you. See you in next video. Till then, happy investing.